Monday. Today is the last day to file your taxes, and many of you have last-minute questions before you file. This Monday, our financial expert Paul Hood is back to answer your questions to make sure that you have all the information that you need, certainly when it comes to an extension, which is not always a bad thing, right?
Oh, extension is a magnificent thing.
Yeah.
People think that, you know, I don't know, I think we're kind of groomed to think, well, I'm filing late. No, you're actually getting outside of that craziness, and it's really, if you don't file your return before March 15th, you should file an extension.
All right, here we go. We're going to start with Paul has a question. The first one here comes from James Paul. He says, I drive a company truck and I must maintain an average of 20 miles per gallon. The truck averages 16, so I have to pay the 4 miles per gallon difference back to the company. That came out to $1,200, and he wants to know, is that deductible?
Well, in the past you could. They were called unreimbursed employee business expenses, but about 3 or 4 years ago, they actually was a pretty good tax cut for most people. But the one thing that did go against us is they got rid of those expenses, so unfortunately, no, he cannot. If he's an employee, he cannot.
All right, to Tara now. Tara's got a question. She says, I drive a lot as a sales rep for my company. I purchased a car last year, cost a little more than $13,000, filed my taxes online. Do I need to decide if I want to deduct mileage or the actual expense in 2022, or should I start depreciating the vehicle?
So what you track, whether you take actual expenses or mileage, you need to track your total miles and you need to track your business miles. And so typically what happens is we take all your actual expenses, including depreciation, so repairs, gas, insurance, all of that, and we multiply it times that business use percentage, the business miles divided by the total miles. Then we compare the business miles times the standard mileage rate and take the larger of the two. Now, the one caveat is if you elect to take actual expenses in your first year, you cannot switch to mileage after that. In other words, you can't write off the vehicle in the first year and then switch to mileage. So it's generally speaking, if you put a lot of miles on, mileage is better. If it's a higher dollar vehicle or a higher use cost vehicle and you don't put very many miles, actual is generally better.
All right, last question goes to Nancy today. Nancy says, I have more than $30,000 in stock that I'd like to transfer over to my son. Are there any tax ramifications for doing that? Would it be better to gift him little by little over the next few years?
So here's two things. There's two sides of it. There's gift taxes or estate taxes, which is a tax on assets. And then there's income taxes. So there's no income tax ramification for her giving her son that stock, except for when you give something, you have what's called carryover in basis, meaning if mom paid $10 for the stock and it's selling for $50 and gives that stock to son sells it, son has her basis, so has to pay taxes on all that step up. And sometimes that's a planning tool. So if son is in a lower tax bracket, then sometimes that's a good planning tool. Now, for estate taxes, you can give up to $16,000 a year, and it's called a present interest gift, and then you don't have, it doesn't affect anything. Anything above that, then it affects how much you can pass on at death.
Okay. We certainly appreciate your help. My goodness, the past few weeks navigating taxes, it's always confusing. And I was really impressed by how many questions have come in from folks over the past few weeks. And if you have a financial question that you'd like for us to talk about next Monday, maybe we can get off the tax topic come next Monday. You can send in your question right now to moneymonday@griffin.news. Stay